So up until now, this is a very rudimentary chart. Home prices have been growing pretty much like this. Now, a home price cool down, I'll put this in my blue marker, would look more like that, where home prices are still rising, but not as fast as they were before. A home price crash would look like this, where home prices are going down from where they were before. Right now, economists and experts are saying that we're going to see this, a housing price cool down. In order to see this, you have to look at the broader economy, which means jobs. And right now our economy is in a weird place because many people predict that we could be seeing a recession sometime by 2023 because our economy has been slowing down. And the reason why our economy has been slowing down is because of, well, inflation. The cost of everything has gone up so much, from your groceries to your vacation to your housing cost to your car to really anything else. The cost of living has gone up so much faster than wages that people just can't spend as much money as they could have before. Now, this is a really weird thing because at the same time, here are all these companies making record-breaking profits. But what these record-breaking profits don't show you is the number of units sold. The reason why so many companies have higher revenues and higher profits on paper, or at least at the dollar amount, is because they have to charge more money per item. But they're not necessarily selling more stuff. So the reason why their profit number and their revenue number looks higher is because they're selling more units of a higher priced product because inflation has caused the price of everything to go up. But that doesn't necessarily mean that they're making more money because they're not necessarily selling more units. For you to be making more money today than a year ago, and by money I mean actual wealth, not just the number of dollars that you have, you'd have to be making about 10% more money today than you were a year ago because you have inflation at around 8.5%. Now, of course, this inflation number is just the reported number. The real inflation that so many people are facing is significantly higher than 8.5%, but you have to be making at least 8.5% more money today than you were a year ago. So if a company is reporting profits of 6% more today than they were a year ago, it might look like a record-breaking profit, but relative to inflation, it's actually a loss. The reason why the economy is so important to look at when it comes to the housing market is because the economy is what provides jobs, and jobs is what provides people incomes to pay for their rent and their mortgage costs. Now, we know already that we've had a lot of institutions buying up homes across the country, and so even though people haven't been able to afford homes like they could before, homes are still being bought, whether it's by a person or an institution. The concern that everybody has about the economy, which would ultimately lead to the housing market, is if we're entering a point where the cost of homes are going up and mortgage costs are going up, making housing affordability go down because now it's so much more expensive for people to buy homes, while the economy is going down because now if we see a slowing economy, that means we could see more potential layoffs, which means we could see more people potentially not have an income to pay for their housing costs or their mortgage costs or their rent costs. Now we would start to have a problem. Because not only could we see a potential housing market cool down, but we could see home prices go down because now people cannot support their rent, they cannot support their mortgages. This is the part that we don't have an answer to yet because we don't know what's going to happen to the economy for sure. We have lots of people predicting a potential recession, and then we have some people that are saying that we're not going to see a recession. So let's pay attention to that. But now to supplement this higher cost of home ownership, people have been turning to a different kind of mortgage. Now, this isn't a new type of mortgage because we've seen these type of mortgages before, and they are known as adjustable rate mortgages, ARMs. Now, I just have to say this very bluntly. This is probably one of the worst times ever to be getting an adjustable rate mortgage, because an adjustable rate mortgage is a mortgage where the mortgage rate adjusts. If you go out and get an adjustable rate mortgage, you're going to get a low teaser rate for the first few years. So if you go out and get an adjustable rate mortgage, yeah, for the first few years, you're going to have a low mortgage rate, but then it's going to adjust. And if the Fed stays true to their word of raising interest rates significantly, that means that you can expect mortgage rates to be more expensive when it adjusts than what it is right now. So if mortgage rates adjust and then you have a much higher mortgage rate than what you're paying right now, that could put you into a tough situation because now all of a sudden mortgage rates go up, your monthly payment goes up, and if your income isn't going up fast enough to support the higher interest rates, then you can be in big trouble. We saw that happen after the 2008 crash because so many people had adjustable rate mortgages that they were getting because it offered a low teaser rate, and then interest rates went up and people were not able to support the higher mortgage costs. So please be aware of that and take these adjustable rate mortgages with extreme extreme caution. This brings me to the topic of I bonds, which has been gaining in popularity a lot recently. A bond is a loan, and a treasury bond is a loan that you make the government. So if you go out and you buy a treasury bond, you are loaning the government money, and they're going to pay you interest in return for your money. But now there's a new type of treasury bond that has been growing in popularity quite a bit, and that's called the I bond. An I bond is an investment that you can potentially make where the government will pay you back an interest rate depending on what inflation is. So essentially, the higher inflation that we see, the higher interest that you get paid. And right now, at the time of me recording this video, these I bonds are paying out an interest of 9.62%, and that's going to continue through October of 2022. Now, there's a few things that I want to mention about I bonds because many people have been looking at them as a solution to invest your money or grow your money in a way that's going to beat or at least match inflation. That way you can grow your money and then potentially use this money to maybe buy real estate or a home if that's what you wanted to do. So an I bond is a way for you to invest your money, but you have to understand that this 9.62% is not the return that you might see for the whole 5 years or however many years you invest your money into your I bond. The interest rate on your I bond is going to adjust 2 times a year, and the factor that it's going to look at is, of course, inflation. If inflation is rising, the interest rate that you get from I bond is going to go up. If inflation is falling, then the interest rate that you get would go down. Second, there's a cap to how much money you can invest into an I bond, and right now that's $10,000 a year. Third, I bonds are not super liquid because the way they work is it's going to pay you interest over the next 30 years. Now, you are not required to keep your money into the I bond for all 30 years, but if you cash your money out before year 5, there's going to be penalties associated with that. So typically, you're going to have to keep your money in it for at least 5 years if you want to avoid all the penalties. The risk with an I bond is that your success is tied to the health of the United States dollar and the United States government. This is why treasury bonds are considered to be very low risk, because the hope is that we're not going to see the United States government default and that we're not going to see the United States dollar default. So because of that, they're considered to be safer investments, but that's where your risk is tied because you're going to be paid in United States dollar. You don't own any hard assets. You don't own like a physical thing like you do with real estate, but you get paid with this interest. And so, you know, the more inflation that we see, the higher interest that you can get. Now, if you're interested in buying an I bond, you can go to treasurydirect.gov to purchase some. So if you've been thinking about buying a home, but you feel like you're getting priced out of the market, the thing that you need to be aware of is what can you do right now to improve your finances. That way you can afford a home, because the last thing that you want to do is go out and stretch yourself too thin just till you can be a homeowner, and then you're living paycheck to paycheck and you have no more money left over for your savings and for investments to build you wealth. So what you don't want to do is do that, which is why if you want to continue to build your wealth, you need to be aware of what's happening and use your money in a way that's going to continue to benefit you. You find alternative investments, that way you can grow your money, and maybe you work to earn more money, that way you can have more money to buy the home that you want and actually be able to afford it. If you enjoyed the shorter clip from my longer videos, here's another clip that I think you'll love. And while you're at it, if you're interested in learning more about how to invest your money in real estate, our team put together an amazing guide on real estate investing. This guide goes over what real estate investing is, how to start using real estate to generate cash flow, and how to build wealth with real estate. This guide is completely free when you sign up for our daily newsletter. So if you want to read our guide on how to start investing your money in real estate, you can download that guide just by clicking that button right over there. Thank you for watching, and as always, keep hustling.